Hey y'all, this is S.M.A.R.T with Nitram Financial Solutions, where we teach bookkeeping without boundaries. So today what we're going to talk about is smart money. And what does that mean? So every day we wake up, whether we're employees or we own a business, and our goal is to make money. We go to work, we do our job so that we can earn income to provide for ourselves and our families. But managing that money in a way that ensures that you are financially stable, you need to make smart decisions. So we need to make sure that your money is smart. So what I have come up with is, just like we have all heard of SMART goals, which are specific, measurable, achievable, reasonable, and time-based, there are also SMART money goals. We need to make sure that our money is also smart. And so I have changed that acronym to use it in the terms of money. So the S stands for separate accounts. So when you are in business, you need to make sure that your money is in separate accounts across the board. You cannot be having your personal funds coming through your business account, and you shouldn't be having your business expenses going through your personal account. So you need to ensure that your accounts are set up in a way that they are owned by the business, not by you individually, so that you can track your business income and expenses separately from your personal expenses. Because when you mix the two, the government calls that commingling, and you will get fined, penalized, and possibly shut down for mingling your money. The M stands for maintaining good records. So you always want to make sure that you're maintaining good and accurate financial records. So if you do not have an accounting system or an accounting software, you need to invest in one. If you don't have a bookkeeper on hand, you need to find one. You should not be managing your books yourself, because you did not get into business to manage the books. You got in the business to do what it is that you do. And so making sure that you have good and accurate books that are up to date, so that you can also assess how your business is doing. And you can't do that if your books are bad, right? So you need to have your books in order so that you can make sure that you are using that data to drive business growth. Understand how your business is operating so that you can continue to grow. The A stands for analyze your costs. So just like we want to maintain your good records, a part of that is analyzing your costs and your expenses. So twice a year, we do something in our practice called a cost audit. And what that is that we're looking at your expenses with the business owner and making sure that we are assessing if these costs are still necessary for the business. So we're determining if they need to have those expenses in their business. We're looking at if they're getting an ROI on those expenses. We're looking at if there is some alternative, less expensive software, solution, tool, whatever it is that they're paying for, but at a lower cost, so they can get all of the same benefits, features, etc. before a lower cost. And then if none of those are applied, then we determine whether that cost needs to be cut. This is to ensure that the business remains profitable month after month, year after year. The R stands for reserve for taxes. So we follow Profit First in my practice, and we tell clients that they should read the book and follow it as well. I am not a Profit First professional. I do not play one on TV, and I am not getting paid to talk about Profit First. However, I believe that it is something that every business owner should do. Every business owner should read it and implement it into your practice. Most accountants don't like it because there's all these accounts, but if you can set it up properly and do it, it definitely works for the benefit of the business owner. So part of that system is setting aside an account specifically for your taxes. So you will take your percentage of your income that comes in the door, and you're going to put it aside in this account that is specifically for taxes. You can't use it for anything else in the business. It is only for taxes. And what that has done is allow myself and our clients, when taxes are due, I have money there to pay for those taxes. I don't have to worry, stress, get frustrated, overwhelmed, anxious, all the feelings and emotions, trying to rob Peter to pay Paul, trying to figure out where the money is going to come from, because the money is already set aside. The great thing about that money is that it's set aside for taxes. And if at the end of the year I don't owe taxes, guess what? That's more money into the business that I can invest into the business for other things. So setting aside a bucket to reserve for your taxes. And then the T stands for take your cut first. Again, another thing that's a part of Profit First is that it promotes that you as a business owner are getting your piece of the pie before. So it's reversing the formula, the traditional accounting formula of revenue minus expenses equals profit, and you're taking revenue minus profit to leave what's left for expenses. And so it institutes a way that we can take our money up front, whether it's through quarterly distributions, but also a part of that is to making sure that you have the profitability built into your business so that you can put yourself on payroll. If you are a small business owner that is not on payroll, you should be on payroll so that you can pay yourselves. If your business is not structured where you can legally be on payroll, because LLCs are not legally required to have the owner on payroll, then you should be taking monthly distributions or monthly draws to help support yourself and your family, not paying for your personal things through your business. So that is the SMART acronym re-engineered for SMART money goals. So you need to have separate accounts. You need to maintain good records. Analyze your costs at least twice a year. Really, you should be looking at them every month, but we're doing a cost audit twice a year. Having money set aside to reserve for taxes, and also taking your profits first. So setting aside a bucket where you can take quarterly distributions and putting yourself on payroll. So I hope these tips helped you. If you like these tips, then please feel free to subscribe and share it with anyone that you know. See you guys next week.